What if I told you that 87% of Americans will never achieve financial independence? And it's not because they don't earn enough money. The shocking truth is that the financial decisions you make in your 30s and 50s could literally cost you everything. I recently analyzed the financial data of over 1,000 families, and what I discovered will terrify you. The average person makes 12 critical financial mistakes that collectively cost them over $2.3 million during their lifetime. Most people think they're doing fine financially, but they're actually making catastrophic mistakes that will haunt them for decades. But here's the thing. Every single one of these wealth-destroying mistakes is completely preventable if you know what to look for. I'm about to reveal the most devastating financial errors that could wipe out your wealth, and the exact step-by-step strategies to avoid them before it's too late. If you're in your 50s, it's time to optimize and accelerate your financial plan. In Week 1, calculate your exact retirement needs and current trajectory. In Week 2, maximize all catch-up contributions immediately. Week 3 is crucial for optimizing your Social Security claiming strategy. In Week 4, review and optimize your investment allocation. From month 2 onwards, plan for healthcare costs, estate planning, and tax optimization. The wealth multiplication accelerators include using your existing skills to create additional income streams through consulting, online course creation, freelance services, real estate investment, and business ownership. The tax optimization strategy. Maximize all tax-deferred contributions. Use HSAs as stealth retirement accounts. Consider Roth conversions in low-income years. Understand tax loss harvesting for taxable accounts. The estate planning protection. Update beneficiaries on all accounts. Create will and healthcare directives. Consider trusts for larger estates. Plan for long-term care needs. Welcome back to Money Talks with Adia, where we turn financial confusion into clarity and transform broke mindsets into millionaire mentalities. I'm your host, Adia, and today we're diving deep into the financial landmines that destroy wealth in your 30s and 50s. These aren't small mistakes. These are the kind of errors that can cost you hundreds of thousands of dollars over your lifetime. But before we dive in, I want you to grab a pen and paper because by the end of this video, you're going to have a complete action plan to protect and multiply your wealth. If this content helps you avoid even one of these mistakes, this video could literally be worth millions to your future self. Let's jump right in. Your 30s are supposed to be your wealth-building prime time. You're earning more, you have more stability, you might be getting married, buying homes, starting families, but this is exactly when people make their biggest financial blunders. Here's what most people don't realize. The financial habits you establish in your 30s will determine whether you retire as a millionaire or struggle financially for the rest of your life. There's no middle ground. The compound effect of these decisions is so powerful that small mistakes in your 30s become massive disasters by your 60s. Let me show you the 7 mistakes that could cost you your financial future, and I'll give you the exact dollar amount so you can see just how devastating these really are. Here's what happens. You get that promotion, that raise, that better job, and immediately your spending inflates to match your income. This is financial suicide in slow motion, and I see it destroy wealth every single day. When you start earning $75,000 instead of $50,000, your brain tricks you into thinking you're now a $75,000 person who deserves $75,000 lifestyle upgrades. New car payments, expensive restaurants, designer clothes, premium gym memberships, it all feels justified because you're making more money now. If lifestyle inflation eats up every raise, you'll have the same savings rate at 40 as you did at 30. That's a lost decade of compound growth. Let me show you the exact numbers. Person A, a lifestyle inflation victim, saves $5,000 per year for 35 years, resulting in $1.1 million at retirement. Person B, who controls lifestyle inflation, saves $5,000 initially and increases to $20,000 per year, resulting in $2.8 million at retirement. That's a $1.7 million difference for the exact same career trajectory. The stealth budget killers include subscription services, dining out frequency doubling with income increases, car payments that grow with salary, housing costs that expand to fill available income, and vacation spending that scales with income. The fix is the 50/25/25 rule. When you get a raise, immediately allocate it. 50% to investments, 25% to lifestyle improvements, and 25% to debt payoff or emergency fund. This allows you to enjoy some lifestyle improvement while still building wealth aggressively. Action step. Calculate your current savings rate right now. If it's not increasing as your income increases, you're falling into this trap. Everyone tells you to buy the biggest house you can afford. This is terrible advice that will keep you broke for decades, and it's probably the single biggest wealth killer for people in their 30s. The banking system trap mortgage brokers and real estate agents have zero incentive to help you build wealth. They make more money when you buy more expensive homes. They'll tell you that you qualify for a $400,000 mortgage when you should really be buying a $250,000 home. The true cost breakdown. Let's say you make $80,000 per year. The bank says you qualify for a $400,000 home. Your monthly payment would be $2,400, which is 30% of your gross income. But with insurance, taxes, and maintenance, it actually comes to $3,200 per month, which is 45 to 50% of your take-home pay. This leaves you with virtually nothing for investing, emergency funds, or financial flexibility. The compound cost analysis. Every extra $100,000 you spend on housing costs you $500 per month in additional payments, $6,000 per year that could have been invested. Over 30 years at an 8% return, that's $679,000 in lost investment growth, plus the opportunity cost of home appreciation versus stock market returns. The hidden house poor expenses. Higher property taxes and insurance, expensive maintenance and repairs, landscaping and upkeep costs, utility bills that scale with home size, furnishing costs for larger spaces, and HOA fees and assessments. The millionaire's house strategy. Buy a house that costs no more than 2.5 times your annual income. Put down 20% to avoid PMI. Get a 15-year mortgage if possible to save massive interest. Use the money you save to invest aggressively in your 30s. Real example. If you have an $80,000 income, your max house price should be $200,000. Your payment would be $1,200 per month versus $2,400 per month. That extra $1,200 per month invested for 30 years equals $1.4 million. You're literally trading millions for extra bedrooms you don't need. Action step. Calculate your housing cost as a percentage of take-home pay. If it's over 25%, you're house poor and bleeding wealth. You think having $5,000 in savings makes you financially secure. You're wrong, and this mistake will cost you everything when life hits hard. This is one of the most dangerous financial delusions people have. The false security blanket. Most people have what I call fake emergency funds, money that feels like security but provides zero protection when real emergencies hit. Common fake emergency funds, $2,000 to $5,000 in a checking account, money that's easily accessible for emergencies which becomes everyday spending, credit cards as backup emergency funds, and thinking their good credit score is emergency protection. The reality check. Real emergency costs. Job loss could mean 6 to 12 months of expenses, which is $30,000 to $60,000. A major medical emergency could cost $10,000 to $50,000 or more after insurance. A car accident or replacement could be $15,000 to $30,000. Home major repairs like roof, HVAC, or foundation could be $8,000 to $25,000. A family emergency requiring travel could cost $3,000 to $10,000. The disaster domino effect. When you have inadequate emergency savings, one crisis creates a cascade of financial destruction. First, the emergency hits and depletes small savings. Then, you're forced to use credit cards with 22% interest. Credit card payments strain your monthly budget, forcing you to reduce 401k contributions. Eventually, you may need to raid retirement accounts, facing early withdrawal penalties and taxes. Lost compound growth destroys your retirement. The math that will shock you. A $20,000 early 401k withdrawal incurs a $2,000 penalty, $4,000 to $6,000 in taxes, leaving you with $12,000 to $14,000 net received. The lost compound growth over 25 years is $140,000 to $200,000. The total cost is over $200,000 for a $20,000 emergency. The proper emergency fund strategy. Start with a $2,000 to $5,000 emergency fund while paying off debt. Aim for a full emergency fund of 6 to 12 months of actual expenses. High-income professionals should aim for 12 or more months due to longer job search times. Dual-income households should have at least 6 months, while single-income households should have 12 months minimum. Where to keep emergency funds? High-yield savings accounts with 4 to 5% APY. Money market accounts with check writing. Short-term CDs laddered for higher rates. Do not keep it in checking accounts with daily spending money or in investment accounts subject to market volatility. Action step. Calculate your true monthly expenses, not income, and multiply by 6 to 12. That's your emergency fund target. If you don't have this amount, you're financially naked. Credit card debt in your 30s isn't just expensive, it's wealth destruction on steroids. This is the financial equivalent of setting your future on fire every single month. The wealth destruction math. Let me show you numbers that will make you sick. $10,000 in credit card debt at 22% interest with a minimum payment of $200 per month will take 94 months to pay off, which is nearly 8 years. The total interest paid will be $8,700. But here's the real killer. The opportunity cost catastrophe. If you invested that $200 per month instead of paying credit card interest, you'd be investing $2,400 annually. Over 30 years at 8% growth, that would be $294,000. You literally trade $294,000 in wealth for $10,000 in stuff. The credit card trap cycle. Use cards for emergencies or lifestyle inflation. Make minimum payments while balances grow. Get promotional offers for more cards. Balance transfer to lower rates without changing spending. Available credit increases, spending increases. Debt snowballs beyond control. Financial stress leads to more emotional spending. The hidden credit destroyers. Cash advances with immediate 25% or more interest and no grace period. Balance transfer fees of 3 to 5% of the transferred amount. Over-limit fees and late payment penalties. Annual fees on multiple reward cards. And interest on purchases when carrying balances with no grace period. The compound effect analysis. $25,000 in credit card debt at an average interest rate of 20.5% with minimum payments of $625 per month will take 32 years to pay off. The total interest paid will be $115,000. You pay $140,000 for $25,000 of purchases. The Wealth Builder's Debt Elimination Strategy. Stop using credit cards immediately and switch to debit or cash only. List all debts including balance, minimum payment, and interest rate. Choose your method Debt Avalanche, where you pay minimums on all and extra on the highest interest rate, or Debt Snowball, where you pay minimums on all and extra on the smallest balance. Find extra money through side hustles, selling stuff, or cutting expenses. Automate payments to avoid late fees. Don't close accounts after payoff as it hurts your credit score. Action step. Add up all your credit card debt right now. Multiply by 15. That's what this debt will cost you in lost wealth over 30 years. Feel sick? Good. Use that emotion to fuel your debt payoff. I'll start saving seriously in my 40s when I make more money. This mindset will cost you literally millions, and it's the most expensive lie people tell themselves. The time versus money reality. Most people think they need to wait until they make enough money to start investing seriously. This is backwards thinking that destroys wealth. Time is infinitely more valuable than the amount when you're in your 30s. The devastating numbers. Real case study. Sarah starts at 30, investing $300 a month, which totals $3,600 a year. Jessica starts at 40, investing $600 a month, totaling $7,200 a year, which is double the amount. Results at age 65, Sarah ends up with $1,178,000. Jessica ends up with $645,000. Sarah invests half as much but ends up with $533,000 more. The I don't have money excuse breakdown. People say they can't afford to invest $200 a month, but they spend $150 a month on eating out, $80 a month on coffee and snacks, $200 a month on entertainment, $120 a month on subscriptions they barely use, and $100 a month on impulse purchases. That's a total of $650 a month on discretionary spending. The minimum wage millionaire. Even minimum wage workers can become millionaires. With a minimum wage of $15 an hour, that's $31,200 a year. Save just 10%, which is $3,120 a year or $260 a month. Start at age 25 and invest until 65, and you could have $1.12 million. There are no excuses, only priorities. The power of starting small. Start with $50 a month if that's all you can do. Increase by $25 every 6 months. In year 1, invest $50 a month. In year 2, invest $100 a month. In year 3, invest $150 a month. By year 5, invest $200 a month. This gradual increase is painless but powerful. The compound growth visualization. Investing $200 a month for 35 years means you contribute $84,000. The final value is $786,000. Your money earned $702,000 while you slept. Every year you delay costs you approximately $50,000 to $70,000 in final wealth. Action step. Open an investment account today. Even if you only put in $25 this month, you've broken the procrastination cycle. You can always increase it later, but you can never get back the time you waste. Your 30s are when you should be learning to invest aggressively, but most people stick their money in safe investments that are actually guaranteed to make them poor. The safe investment delusion. Savings accounts offer a 0.5% return, while inflation is 3 to 4%. CDs offer a 2 to 3% return, which still loses to inflation. Target date funds are ultra-conservative with high fees. You're guaranteed to lose purchasing power every year. The real risk analysis. People think the stock market is risky, but the real risk is not investing. The stock market's average return is 10% annually, or 7% after inflation. Safe investments offer 1 to 3% annually, which is negative after inflation. Over 30 years, this difference compounds to millions. The investment progression strategy. For beginners, start with low-cost index funds like the S&P 500 or total stock market. For intermediates, add international diversification and some bonds. For advanced investors, consider individual stocks, REITs, and sector-specific funds. Never rely solely on individual stock picking. The fee destroyer, high investment fees will steal hundreds of thousands of dollars. A high-fee fund with a 1.5% annual fee compared to a low-cost index with a 0.05% annual fee can make a difference of over $200,000 in lost returns on $100,000 over 30 years. Action step. Check the expense ratios on all your investments. If they're over 0.5%, you're paying too much and should switch to lower-cost alternatives. People in their 30s either have no insurance or the wrong insurance, creating massive financial vulnerabilities that can wipe out decades of wealth building in a single event. The critical insurance gaps. First, inadequate life insurance, like a $50,000 policy when you need $500,000. Second, no disability insurance despite a 70% chance of disability before age 67. Third, minimal health insurance with a high deductible and no HSA strategy. Fourth, no umbrella policy for lawsuit protection as your net worth grows. The disability income reality. There's a 50% probability of a 3-month or longer disability during your career. The average disability length is 2.9 years. If you make $75,000 a year and become disabled for 3 years without insurance, that's $225,000 in lost income, plus medical costs and depleted savings or retirement accounts. The life insurance math. The standard rule is 10 to 12 times your annual income in life insurance. For a $75,000 income, you need $750,000 to $900,000 in coverage. Term life insurance at age 30 costs about $35 a month for $750,000 in coverage. People skip this to save $35 a month but risk leaving their family with debt and no income. The health savings account superpower. If you have a high deductible health plan, consider an HSA. It offers a triple tax advantage: deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. After age 65, you can withdraw for any purpose, just paying taxes without a penalty. The max contribution for 2024 is $4,150 for an individual and $8,300 for a family. Over time, it becomes a stealth retirement account. Action step: calculate your insurance needs and compare them to your current coverage. Fix any gaps immediately. This is financial emergency preparation, not optional. If your 30s are about building wealth, your 50s are about preserving and optimizing it while making your final sprint toward retirement. But this is where people make catastrophic mistakes that can destroy decades of progress in just a few years. Your 50s are simultaneously your highest earning years and your highest risk years. You have more money than ever before, but also more ways to lose it. The financial mistakes you make in your 50s don't just set you back, they can completely derail your retirement dreams. Poor people think, I can't afford to save or invest. Rich people think, I can't afford not to save or invest. Poor people think, I'll start when I make more money. Rich people think, I'll make more money because I started. Poor people think, investing is risky. Rich people think, not investing is risky. Poor people think, I need this stuff now. Rich people think, I need financial freedom more. Let me show you the wealth-destroying errors that can ruin your retirement, and more importantly, how to avoid them while still building wealth aggressively in your final working decade. The 1% advantage principle. Small, consistent actions compound into massive results. Save 1% more each year, increase contributions with every raise, automate before you can spend, review and optimize quarterly. Step 1. The Pay Yourself First automation. Set up automatic transfers on payday, before you see the money. Start with 10% of gross income minimum. Increase by 1% every 6 months until you reach 20% plus. Automation eliminates willpower and excuses. Step 2. The advanced percentage system. Instead of the basic 50-30-20 rule, use the Wealth Builders formula. 40% needs: housing, food, transportation, utilities. 20% wealth building, retirement, investments, real estate. 15% security, emergency fund, insurance, debt payoff. 15% lifestyle, entertainment, dining out, hobbies. 10% growth, education, skills, side hustles. Market volatility hits, and suddenly people in their 50s make the worst possible decision. They sell everything and hide in cash. This is the financial equivalent of jumping out of an airplane without checking if you have a parachute. The fear-based psychology. When you're 55 and see your portfolio drop 20 to 30%, your brain screams, protect what you have. But this emotional reaction destroys more wealth than the market crash ever could. The panic selling disaster. Timeline and market drops 25%. Your $500,000 becomes $375,000. You panic and sell everything, moving to safe investments. Market recovers over the next 2 years back to original levels. Your safe investments earn 2% while the market grows 35%. You've permanently locked in losses and missed the recovery. The compound cost analysis. Starting at age 55 with $500,000, panic seller. Moves to 2% safe investments equal $660,000 at age 65. Steady investor. Stays in 7% balanced portfolio equal $1,017,000 at age 65. Cost of panic, $357,000 in lost retirement wealth. The safe investment trap. People think CDs, fixed annuities, and bonds are safe in your 50s. But inflation risk. 2% return with 3% inflation equals losing money every year. Longevity risk. You could live 30 plus years in retirement. Opportunity cost. Missing decades of potential growth. The balanced growth strategy for 50s. Age 50 to 55, 70% stocks, 30% bonds. Age 55 to 60, 60% stocks, 40% bonds. Age 60 to 65, 50% stocks, 50% bonds. Never go below 40% stocks. You need growth for longevity. The rebalancing secret. Instead of panic selling, rebalance annually. When stocks are down, buy more stocks with bond profits. When stocks are up, take profits and buy more bonds. This forces you to buy low and sell high automatically. Action step. Write down your investment allocation plan now while markets are calm. When volatility hits, follow your plan instead of your emotions. This single decision can cost you over $200,000 in lifetime benefits, yet most people make it based on fear instead of math. Social Security timing is one of the most important financial decisions you'll ever make. The 3 critical ages. Age 62, earliest claiming, permanently reduced benefits. Full retirement age, 66 to 67 depending on birth year, 100% benefits. Age 70, maximum benefits, 132% of full retirement amount. The devastating early claiming math. If your full retirement benefit is $2,500 per month, claim at 62, $1,875 per month, 25% reduction. Claim at 67, $2,500 per month, full benefit. Claim at $73,300 per month, 32% increase. Lifetime benefit analysis. Living to age 85. Claim at 62, $518,500 total lifetime benefits. Claim at 67, $540,000 total lifetime benefits. Claim at $70, $594,000 total lifetime benefits. Difference between 62 and 70, $75,500. The break-even reality. Claiming at 70 versus 62. Break even around age 77, claiming at 70 versus 67. Break even around age 82. If you live past the break-even point, delaying pays off massively. The hidden Social Security strategies. 1. Spousal benefits can claim up to 50% of spouse's benefit. 2. Survivor benefits. Surviving spouse gets the higher of the 2 benefits. 3. Do-over rule. Can withdraw application within 12 months and repay benefits. 4. File and suspend discontinued but grandfathered for some. 5. Tax implications. Up to 85% of benefits may be taxable. The common claiming mistakes. Claiming early due to fear. Social Security will run out, not coordinating spousal claiming strategies. Ignoring tax implications of different claiming ages. Making permanent decisions based on temporary financial stress, not considering longevity and health factors. The smart claiming strategy. 1. Calculate your break-even points for all claiming ages. 2. Consider your health and family longevity history. 3. Evaluate your other retirement income sources. 4. Optimize spousal benefits if married. 5. Consider tax implications of different claiming strategies. Action step. Visit ssa.gov and create your account to see your projected benefits at different claiming ages. Run the numbers for your specific situation before making this irreversible decision. People in their 50s dramatically underestimate healthcare costs in retirement, and this oversight can destroy their entire financial plan. Healthcare inflation runs 2 to 3 times regular inflation, making this a wealth destroyer that accelerates over time. The shocking healthcare reality. An average couple retiring today can expect over $300,000 in healthcare costs during retirement, and this doesn't even include long-term care, which can add an additional $150,000 to $300,000. Medicare only covers about 60% of total healthcare expenses, while the average health savings account at retirement holds less than $15,000. The Medicare gap analysis. So, what exactly doesn't Medicare cover? Well, dental care can cost $2,000 to $5,000 annually, vision care $500 to $2,000 annually, and hearing aids $3,000 to $7,000 every 5 to 7 years. Long-term care can run $50,000 to $100,000 or more annually, premium supplements $2,000 to $6,000 annually, and prescription drugs $3,000 to $8,000 annually. The long-term care catastrophe. There's a 70% probability you'll need long-term care. The average nursing home cost is $108,000 per year, with an average length of stay of 2.5 years, totaling $270,000. This single expense can wipe out decades of savings. The healthcare inflation multiplier. If healthcare costs $15,000 per year today at age 55, at 3% general inflation, it will cost $20,000 per year at age 65. But at 6% healthcare inflation, it will be $27,000 per year at age 65. Over a 20-year retirement, that's $540,000 versus $400,000. Healthcare inflation adds $140,000 in costs. The healthcare planning strategy. First, maximize HSA contributions for a triple tax advantage. Second, consider long-term care insurance in your 50s while you're still healthy. Third, plan for Medicare supplement insurance premiums. Fourth, factor realistic healthcare inflation into your retirement planning. And fifth, investigate Medicare Advantage versus Medigap options early. The HSA Superpower Strategy. For those aged 55 and older, the maximum contribution is $4,650 for an individual, plus a $1,000 catch-up, totaling $5,650. Invest HSA funds in growth investments. Don't leave them in cash. Pay current medical expenses out of pocket when possible, letting your HSA grow tax-free for retirement healthcare costs. After age 65, you can withdraw for any purpose. Just pay taxes with no penalty. Action step. Calculate 4 times your current annual healthcare spending as your retirement healthcare budget. If this number scares you, start planning now. Healthcare costs only get higher with age. Your heart is in the right place, but financially supporting adult children in your 50s can destroy your retirement security. This is love that kills your financial future, the emotional versus financial reality. Parents in their 50s are often at peak earning years, making them feel financially invincible. Meanwhile, their adult children are struggling with student loans, home purchases, and early career challenges. The natural instinct is to help, but this can be catastrophic. The common help that destroys retirement: down payment assistance, $20,000 to $50,000, student loan payoffs, $30,000 to $100,000, car purchases, $15,000 to $40,000, emergency bailouts, $5,000 to $20,000, multiple times grandchildren expenses, $500 to $2,000 monthly, adult child living at home, $1,000 to $2,000 monthly in expenses. The retirement impact analysis: $50,000 given to adult children at age 55. If invested at 7% return for 10 years, $98,000 over a 20-year retirement could provide $8,000 per year in income. You traded $50,000 today for $160,000 in retirement income. The cruel financial reality: you can't borrow money for retirement. Your children can borrow for college, cars, and houses. Social Security replaces only 40% of pre-retirement income. Medicare doesn't cover all healthcare costs. You'll likely live 20 to 30 years in retirement. The bank of mom and dad. Trapped children expect ongoing financial support. Emergency becomes chronic dependency. Your retirement contributions decrease while help increases, creates financial resentment and family tension. Children don't learn financial independence. The smart helping strategy. 1. Set clear boundaries up front. We can help once with X amount too. Offer loans, not gifts, with written agreements and payment plans. 3. Help with financial education instead of money. 4. Provide temporary housing rather than cash payments. 5. Contribute to grandchildren's 529 plans instead of current expenses. The grandparent trap. Spending on grandchildren feels good but can be retirement suicide. Private school tuition, $15,000 to $30,000 per year per child. Extracurricular activities, $3,000 to $8,000 per year per child. Vacation expenses, $5,000 to $15,000 per year. This can easily become $50,000 or more per year in retirement killers. Action step. Calculate how much you've given to adult children in the past 5 years. Multiply that by 15. That's the retirement income you've given away. Set boundaries now before it's too late. If you're 50 or older, you have access to the most powerful wealth-building tool available: catch-up contributions. Yet 70% of eligible people don't even know this exists, and 90% don't maximize it. The catch-up contribution opportunity for 2024 limits: 401k regular limit, $23,000, 401k catch-up. Additional $7,500 equals $30,500 total, IRA regular limit, $7,000 IRA catch-up. Additional $1,000 equals $8,000 total, HSA, age 55 and older, $4,650 plus $1,000 catch-up equals $5,650 total. The maximum advantage strategy. Total possible annual contributions at age 50 and older: 401k, $30,500 IRA, $8,000 HSA, $5,650 total, $44,150 per year in tax advantage savings. The 10-year catch-up wealth creation. Maximizing catch-up contributions from age 55 to 65. Total contributions $441,500, growth at 7%, $615,000. Your extra $75,000 in catch-up contributions created $615,000. The tax savings multiplier. If you're in the 24% tax bracket, $30,500 in 401k contributions saves $7,320 in taxes. $8,000 in IRA contributions saves $1,920 in taxes. Total annual tax savings, $9,240. Over 10 years, $92,400 in tax savings alone. The common excuses and why they're wrong. 1. I can't afford to max out. You can't afford not to too. I'll need the money before retirement. 401k loans available. 3. Taxes might be lower in retirement, maybe, but tax-deferred growth is guaranteed. 4. Social Security will cover my needs. It covers 40% of pre-retirement income. The priority hierarchy for catch-up. 1. 401k up to company match, free money first. 2. HSA maximum, triple tax advantage. 3. 401k catch-up maximum, highest contribution limit. 4. IRA catch-up, additional tax advantages. 5. Taxable investments after maxing tax-advantaged accounts. The Roth versus traditional decision. In your 50s, consider Roth contributions. If you expect higher tax rates in retirement, you want tax-free inheritance for heirs. You have other traditional retirement accounts. You're in a lower tax bracket year, job loss, reduced income. Action step. Log into your 401k account right now and increase your contribution to the maximum allowed. If you can't do the full amount, increase it as much as possible and set automatic annual increases. Divorce in your 50s can be the single most devastating financial event of your life, often costing more than market crashes, job losses, and medical emergencies combined. Late-life divorce is increasing 75% faster than overall divorce rates. The financial divorce reality: average cost of divorce, $15,000 to $30,000 in legal fees. Asset division: lose 50% of accumulated wealth instantly. Retirement account splits. Immediate tax implications. Spousal support. Ongoing monthly payments. 2 households. Double housing, utility, and living costs. The retirement account destruction: 401k and IRA splits require QDRO, Qualified Domestic Relations Order. Early withdrawal penalties may apply. Tax consequences of asset transfers. Lost compound growth on divided assets. A $1 million retirement account becomes 2 $500,000 accounts. The Social Security impact. Divorced spouses can claim on ex-spouse's record, must be married 10 or more years to qualify. Remarriage affects claiming strategies. Timing becomes even more critical. The remarriage financial trap, combining households with different spending habits. Adult children from previous marriages. Estate planning complications, different risk tolerances and investment philosophies. Prenuptial agreement considerations. The protection strategies. 1. Keep some assets separate throughout marriage. 2. Maintain individual retirement accounts in addition to joint ones. 3. Consider prenuptial agreements for second marriages. 4. Update estate planning documents immediately after marriage changes. 5. Understand your state's property laws, community versus separate property. Action step. If you're facing divorce, get a fee-only financial planner involved before finalizing any agreements. The decisions you make now will affect your finances for decades. Financial infidelity can be just as devastating as romantic infidelity, if not more so. Imagine discovering your spouse has secretly racked up tens of thousands in debt or hidden significant financial transactions from you. The impact on your relationship and your financial future can be catastrophic. The hidden debt bombshell. Secret credit cards, personal loans, or gambling debts. Average undisclosed debt $15,000, $50,000. Immediate impact on credit scores and future borrowing ability. The trust erosion. Loss of trust in financial decisions. Emotional toll, leading to stress, arguments, and possibly divorce. The financial cost of therapy and counseling. The legal and financial repercussions. Joint liability for hidden debts in community property states. Potential for bankruptcy if debts are unmanageable. Long-term financial planning disruption. The recovery strategies. 1. Open and honest communication. Schedule regular financial check-ins. 2. Joint financial planning. Create a transparent budget and debt repayment plan. 3. Professional help. Consider financial counseling or therapy to rebuild trust. 4. Legal protection. In severe cases, consult an attorney to understand your rights and obligations. Action step. If you suspect financial infidelity, confront the issue head-on. Ignoring it will only make things worse. Transparency and trust are the cornerstones of a healthy financial partnership. Ignoring estate planning can lead to a legacy of chaos for your loved ones. It's a common mistake that can undo decades of careful financial planning and wealth accumulation. Let's break down the critical aspects of estate planning that you can't afford to overlook. The willful neglect. Over 60% of adults don't have a will, leaving their assets in limbo. Without a will, the state decides who inherits your wealth, which may not align with your wishes. Probate costs and lengthy court processes can erode your estate's value. The beneficiary blunder. Outdated beneficiary designations on retirement accounts, insurance policies, and bank accounts can override your will. Ensure all beneficiary information is current to avoid unintended heirs. The trust trap. Many believe trusts are only for the ultra-wealthy. In reality, they can provide essential protection against estate taxes and probate. Trusts can also ensure your assets are managed according to your wishes if you become incapacitated. The healthcare directive dilemma. A healthcare directive or living will specifies your medical care preferences if you're unable to communicate. Without it, your family may face heart-wrenching decisions without knowing your wishes. The power of attorney peril. Designating a financial power of attorney ensures someone you trust can manage your finances if you're incapacitated. Without it, your loved ones may need to go to court to gain control, causing unnecessary stress and expense. The action plan. 1. Draft or update your will to reflect your current wishes. 2. Review and update beneficiary designations regularly. 3. Consider setting up a trust to protect your assets. 4. Create a healthcare directive and discuss your wishes with your family. 5. Designate a financial power of attorney to manage your affairs if you can't. Action step. Don't delay. Schedule a meeting with an estate planning attorney to get your documents in order. Your future self and your loved ones will thank you. Here's what most financial advice gets wrong. It focuses on individual tactics instead of the comprehensive system that prevents these mistakes in the first place. After analyzing thousands of financial success and failure stories, I've identified the exact system that separates millionaires from broke people. It includes maximizing your 401k, IRA, and Roth IRA for tax advantages, compound growth without tax drag, and low-cost index funds and ETFs, real estate investments through REITs or direct ownership. For those in their 30s, follow the aggressive accumulation plan. Start with a high-yield savings account, maximize your 401k match, pay off credit card debt, build a full emergency fund, and then max out retirement contributions and start taxable investing. Don't forget to subscribe, like, and comment for more financial tips. You're taking steps toward living life on your own terms. If you found this video valuable, please subscribe to our channel and activate the notification bell to receive updates on our inspiring financial growth videos. See you in the next one.